All right, we are now live. So, hello and welcome to those of you joining us just a few minutes early. My name is Charlotte. I'll be your money show host for this session. I do have Brian London here with me in the Zoom room. We are ready to begin his presentation on time. Just a few short minutes now at 1:05 p.m. That is Eastern Time. Thank you so much for your patience. Hope you're enjoying the show so far. And if you are looking for something to do while you wait, excuse me, feel free to scroll on down to the virtual booth right below the video player here. There are some handouts for you available, and I believe there's a video for you to play as well. Again, if you're looking for something to do while you wait. Thank you. Just a minute to go here before we get started. I see a few more people joining us, so I just wanted to pop in again and say hello and welcome. Feel free to type something into the live chat box if you want to say hi to your fellow attendees. This will be where you guys can place any questions you have throughout the session. So feel free to get familiar with it now. We'll be getting started in just a minute. Thanks again for your patience. Hello, everyone, and welcome to the session. It is my pleasure to introduce to you Brian London, the executive editor and publisher of Gold Newsletter and the host of the annual New Orleans Investment Conference. Now, to our live viewers, please share any questions you may have in the chat box, time permitting. We'll see if we can get to some of those during Q&A at the end. And with that all said, Brian, I will hand the mic on over to you. I will be here if you need me, but the floor is all yours.
Thank you, Charlotte. Hello, everyone. I'm going to run through our important presentation, I believe, today, and hopefully we will have enough time at the end for some questions. But we're talking about gold today. This gold bull market has been making a lot of headlines, and deservedly so. This may be the most explosive, even violent rise in gold prices that we've seen since January of 1980. And there are a number of factors behind this run, some unseen factors as well, I believe, and a lot of factors that are mentioned in the mainstream media that are essentially, in my view, irrelevant. So we will try to cover all of these and give you an idea of what I believe are the fundamental driving forces that are pushing gold and silver and mining stocks higher right now, and I believe will continue to do so. The title of my presentation is Bigger Gains, Less Risk. And while I'll go over this in the presentation, I'll preface it right now by saying the less risk part comes by the fact that the traditional levers, and in fact the assets that often lead gold in a bull market, have actually lagged far behind gold in this bull market. It is a unique run in gold because of this, and for the reasons that gold or that mining stocks in silver have lagged gold. So the hard part has been done. We have established a gold bull market. The risk of that happening is removed So therefore, there is less risk in buying those assets now that have lagged gold and are now poised to make up for lost time, and are doing so as I speak. So let's get started. First off, there are two reasons to own gold that, in my view, and I've often said this, one is as insurance, the second is as investment. So let's look at the first reason right now. Number one, insurance. Let's ask this question. If I was with a live audience, I would ask, what is the US dollar worth today? And a number of people would scream out the latest numbers for the US dollar index. And my view would be, who cares? The dollar index is the rating of gold versus or against its trade partner currencies. It is merely a measure of which currency happens to be leading the race to the bottom of the hill at any point in time. It is irrelevant to our discussion. It is irrelevant to the value of gold vis-a-vis the dollar or any other currency. But you have to know, the US dollar today is worth 1/3,640th of an ounce of gold. Actually, it's worth much less because I forgot to update this chart. So in just a couple of days since I prepared this slide, gold has already advanced strongly against the dollar, or the other way of looking at it, the dollar has fallen even further against gold. So what is the US dollar going to be worth tomorrow, next year, or 5 years from now? Well, we have a pretty good idea, less. Here's a chart of the purchasing power of the US dollar since 1965, which is when they removed silver from US coinage. You can see, even though this chart has not been updated recently, that the US dollar has lost about 90% of its purchasing power over that time frame. During the lifespan, during the adult experience of many people who are watching this presentation right now. This is not new. This has happened before. This has happened over and over again, constantly throughout human history, in every civilization. Every communal organization of humans under any sort of government where there has been a currency, that currency has always been devalued. In fact, every currency before the US dollar, before modern currencies, has eventually gone to zero. This is being repeated as we speak. Here we see a chart of the silver content of the Roman denarius alongside a quote from Cicero as the Roman denarius is being devalued. If you read that quote, if you take time to read it, you'll see that many of those same issues are the same ones being discussed today. The speakers that we listen to today, the speakers that you'll hear today in this virtual conference and on my stage in New Orleans, if you imagine them in robes in a Roman Forum, they would be saying the very same thing. None of this, in fact, is new. Some things never change. One aspect of human nature remains consistent over the millennia. Leaders will overspend and debase the currency. It's interesting to note that the debasement of the Roman denarius was due to the military adventures in foreign lands, entitlements, bread and circuses, a number of things that have direct analogs to what we're seeing today. Another thing consistent over millennia is that gold will protect purchasing power. Here we have a chart of the value of gold in dollars and the value of the dollar as a percentage of its 1973 value left on the left chart. And you can see as that blue line, which is the value of the dollar, falls, that the value of gold, not in a straight line, but the value of gold rises over this broad sweep of history. In fact, this chart should have begun in 1971 when the dollar's attachment, last remaining attachment to gold, was severed by Richard Nixon. Everything, or virtually everything, a lot of things changed on that day in 1971. But again, the point here is that gold rises as the purchasing power of the dollar and every other currency falls. And this is the important point I want to get at in this section of the presentation. We need to maintain a gold-centric mindset. We need to understand that gold itself is a constant around which all other values revolve and against which currencies have always depreciated. Let me try to explain this. Now, there's a great website called pricedingold.com that plots a number of different assets, items, consumer items, assets, indices, etc., and values them in gold, simply divides their current value, then current value, by the value of gold, the amount of gold at current prices that it would take to buy that asset over time. So when you do that, you see that much of what we've experienced over decades has simply been the depreciation of the dollar or the depreciation of whatever your home currency may be. Measured in gold, for instance, as this chart shows, the Dow Jones Industrial Average is trading at lower levels than 1930. An Ivy League education cost the same in gold as in the 1930s. It would have cost you the same amount of gold in ounces in 1930 to buy a Yale education as it would today. The Big Mac is actually cheaper valued in gold in any currency, against any currency, than in the 1980s. Now, there's one asset, one index, let's say asset in scare quotes, against which gold has often not been able to keep up, and that is federal debt. If you measure the US federal debt, in this case, you have to use kilotons of gold, from 1900 to say 1920, as far as this chart has been updated by pricedingold.com, you see that oftentimes, and that's when these red arrows, the value or the federal debt has risen more quickly than the price of gold has been able to keep up. Now, there are some exceptions to this, important exceptions, and those are marked by the green oblongs here. The first one you'll notice is the 1970s. That was one of these catch-up periods in gold. If you remember that long-term gold chart I showed you, as the dollar depreciated, gold did not go up in a straight line. It would remain dormant for many years, but when we would have a period where the public felt that their future purchasing power was going to be more rapidly depreciated, then gold caught up. The price of gold rose to reflect that. The important periods where that happened were the 1970s, the 2000s, and remember, these are periods when gold soared in value, and so did associated investments. And then we see that shortly before 2020, we began another one of those periods. In fact, this line has continued downward. So this, in my view, is another one of these major secular mega trend moves in gold that we are right in the midst of. So that brings us to our second reason to own gold: investment. When the macro trend argues for gold price catch-up, when people become concerned about their future purchasing power, it's time to invest in gold. And we can see by the amazing moves in the gold price over the last 18 months that this is one of those periods. So what causes declines in a currency's purchasing power? Simply put, spending and debt creation. The lesson today is that we've entered the end game of a 4-decade plus, a 45-year trend, in fact, of ever easier money. This trend began in around 1980, when Paul Volcker, Fed chairman, killed off inflation by raising interest rates above 20%. After that, every time that there was a recession, the prescription by the Fed, the prescription by central banks everywhere was the same. They would lower interest rates. They would ease monetary policy. And you can see that recessions are the shaded areas in this chart. The blue line is the Fed funds rate, the Fed funds effective rate, which is, in fact, the only interest rate that the Fed has direct control over. We see that there were a number of rate cutting cycles over the years, almost all coinciding with recessions. I've marked the bottoms, although one of these red lines veered off a bit. But I've marked the bottoms of these rate cutting cycles with the red line, and you can see it's a steady stair step down to ground level after the 2008 financial crisis when they went to zero. The Fed tried to raise rates afterwards, and then with COVID had to go right back in 2020 to zero. Subsequently, they raised rates and then have started cutting them again. Now, it's important to note here that after 2008, they came up with a number of other programs, primarily quantitative easing, because lowering the rate to zero was not enough to get the reaction from the markets. The markets had become addicted to ever easier money, and like a drug addict, they needed a greater dose of the drug to overcome that tolerance. In 2020, post-COVID, the Fed did everything they did over 4 to 5 years, post-2008, but they actually did it over 4 to 5 days. The point here being that in the next crisis, they will have to ramp things up even more, and it will really blow your mind what they come up with next. So again, as we see monetary policy getting ever easier, we see that that red line, which is gross federal debt, rose alongside. Easier money, ever easier money, encourages ever greater debt accumulation. Now here is a very important chart that plots federal debt, which is again the red line, against federal interest expense. We can see that the red line goes up and then post-2008 rises precipitously. But after that quick rise, after 2008 and that recession, the interest expense didn't rise that quickly at all. That's because interest rates were forced into the ground, forced to a zeroed interest rate environment. But then you see, when the Fed began raising rates only slightly, that interest expense soared, in fact, soared to over $1 trillion a year just in interest. Excuse me. Which brings us to today, with over $37.5 trillion in national debt. This debt is, at this point, frankly, unmanageable. Absolutely unmanageable, and the reason why is circled below in blue. In 1980, when Paul Volcker was the Fed chairman, the US federal debt to GDP ratio was about 35%. So Volcker could raise interest rates to those very high levels without increasing without increasing the bottom line cost of servicing the debt. Now, however, the federal debt to GDP ratio is over 120%, which means that Chairman Powell today, as much as he would like to be Paul Volcker, just does not have the same toolbox. He cannot keep rates at these levels, which is one of the reasons he's desperate to lower rates. He can't leave rates at this level because when you do, this happens. This is federal government current expenditures on interest alone. As you can see, it's soared over $1 trillion, and that is the result of raising interest rates just to their 5.5% or thereabouts, which historically is still low, but in the current environment is far, far too high. So let's take a look at where we are. The Fed, as we've seen, has launched a new easing cycle in the US, and the markets have recognized that. That is one of the primary reasons, as you'll shortly see, for this latest surge in the gold price. Now, while this has been happening, central banks continue to buy gold to insulate them from dollar hegemony. Central banks began buying gold, not coincidentally, right after Russia's invasion of the Ukraine and the very harsh sanctions that were imposed on Russia by the allies. Even US allies that were part of those sanctions recognized that powerful weapon of dollar weaponization could one day be pointed at them. So they've been trying somewhat desperately to insulate themselves by adding gold to their reserves. Now, as to that new easing cycle, we can see that this latest rally in gold began almost immediately after Jerome Powell essentially conceded an upcoming rate cut in his Jackson Hole speech. That rise accelerated as subsequent jobs data in the U.S. came in to confirm a U.S. economic slowdown that might promote or encourage this Fed to have more than that initial rate cut. In fact, the latest dot plot shows that Fed governors, FOMC committee members, are expecting as many as 2 rate cuts before the end of this year. And next year, as we know, come May, President Trump will have his man in the Fed chairman's seat, and that will usher in a period of even more rapid monetary easing. That is one of the things that this rally in gold is recognizing at this moment. Now, central banks, if we look at that, we see that gold's share marked in blue of international reserves and the US dollar's share of international reserves are headed in different directions. The dollar share is falling rapidly, gold's share is rising rapidly, and they seem destined to meet at some point. Some charts tracking simply US Treasuries and international reserves show that gold has already crossed that line. It's important to note that gold is rising in central bank reserves, and it's rising at the expense of the US dollar. And now we're seeing in recent months that investors are not only starting to buy gold, but they're also buying mining stocks and silver. And by investors, I mean primarily Western investors, which have been largely absent in this bull market. And mining stocks and silver have lagged because central banks have been driving the bus, mostly so far. And central banks simply do not buy mining stocks and they do not buy silver. Let's show an example of this, and that's the major gold ETF, the one in the West, the GLD Spider Gold Shares ETF. We can see the total tons held has been rising really all this year. If I can go back, is while the share price or the price of gold has been rising alongside. So this shows that Western investors, this is a great proxy for Western investment demand. Western investors are actually participating now in buying gold. Again, they're actually buying gold stocks as well. This is a chart of the GDX index of major mining stocks plotted against the gold price. When this line is rising, the gold ETF, the mining stocks ETF, is outperforming gold. We can see that if you go back to the beginning of August, really, they have begun outperforming gold as if they were shot out of a cannon. And this is remarkable when you consider what gold itself has done over this time period. So to outperform that, it's quite impressive. Now, to our next chart, silver has broken out. This chart goes back to the 2011-2012 high when silver hit the nominal high of $50 for the second time in history. As you can see, silver is making up for lost time. That $35, $35 resistance was very strong, and it broke out of that earlier this year and now seems destined to reach $50. Here we see the tremendous breakout in gold over the last month, and this chart was done yesterday. It's already out of date because gold is up another 30 some odd dollars today, over $3,700. So the move continues. 3 month, you can see the violence really of this move, and you can also see that there was gold was restricted to a range throughout the summer and recently broke out, and we're seeing that rally continue right now. Now, let's take a longer term look at the history of this gold bull market. And you can see that there have been 3 periods of this kind of sideways consolidation, 4 upward thrusts, of which the latest is the most recent example. We are in that right now. We could go a lot longer, but this rise in particular has been particularly abrupt and steep. But the bottom line is that this is another long-term monetarily based gold bull market, like the 1970s and the 2000s. So where can this go? We are in uncharted territory. So technically speaking, or from the charts, how do we know how far we could go? Well, let's look at the previous gold bull markets. I divide the 1970s into 2 gold bull markets because there was a bear market from 1974 to 1976. If we chart it this way, the early 1970s, gold went from trough to peak 5.6 times in price, the late 1970s 8.2, the 2000s 7.5. If you plot the bottom of this bull market around $1,050, as I do in December of 2015, then we should go up 6 to 8 times thereabouts in the gold price from that bottom. That implies a $6,000 to $8,000 gold price whenever this cycle ends. However, if you include the 1970s as one gold bull market, you see that from trough to peak, it went up 24.4 times. That gives us a gold price, which I think is a long shot, but possible, over $20,000. Here's how we can get that way. If we backed M2, for example, by just 40%, it would project to a gold price of over $20,000. M2 at 100% would be $50,000. So that's one way you could get to these seemingly fantastic numbers. One way to play this, the way we focus on in Gold Newsletter, is through the highly volatile, highly risky, but potentially highly rewarding area of junior mining stocks. One of our better examples of what can be done in this area is Great Bear Resources, which went up 87 times from this entry price in our Gold Newsletter alert. This is an area that, again, can be very rewarding, but it is very risky. Now, I'm going to provide you a little dessert with this dinner. Here are 4 specific recommendations. I would caution you that after producing these recommendations, I realized I own every one of them. That was not my intent, but I own an awful lot of these stocks right now. Less risky in a high risk, high potential sector. Banyan Gold, big resource, gold resource in the Yukon. BlackRock Silver, a very large silver resource in Nevada. Riskier, high potential drill plays that are trying to find gold resources. Prospector Metals, also in the Yukon. Relevant Gold in Wyoming, of all places, with a very interesting geologic theory. I personally own positions in all of these stocks. Thank you, and it looks like I've left enough time for some Q&A. You can reach me or learn more about Gold Newsletter at goldnewsletter.com. You can learn about the New Orleans Investment Conference coming up rapidly. If you register shortly, you'll be able to save as much as $400 a person on your full registration fee for that conference. It's November 2nd to 5th. I strongly recommend that you go to our website, neworleansconference.com, and look at our speaker roster. I think you will be very impressed. And you can follow me on Twitter/X at Brian_London. So there we have it. And Charlotte, if we have any questions, I'd be happy to address them.
Fantastic. We do have a couple questions here. I will start with this from Nicholas. A couple of these are from earlier when you were just started your presentation. So apologies if you've covered any of this. But Nicholas had asked, is it best to invest in owning the metal or paper contracts?
You can do both. I recommend that anyone who is new to the sector and has not built up a significant physical metals holding, a holding that is easily accessible, not in a bank safe deposit box, because one of the things you're insuring against is a bank holiday, a location known only to you and loved ones, highly trusted individuals, that you have some physical metals close at hand and physically stored. The ETFs, the paper representations, are one way to expand your exposure in a very convenient liquid fashion. I like the Sprott Bullion Trust for gold, silver, the PGMs, even some mining stocks, and even uranium. I trust the Sprott organization to actually have the metal in hand in those trusts. I don't assign the same level of trust to other ETFs, quite frankly.
Thanks, Brian. And I just had this one from Alyssa. She's wondering if you can go back to the slide that had your 4 recommendations.
Yes, I will see how I can do that.
Yes, if we could just pop that back up. I'm sure she just wants to take a photo of it.
Yeah, there you go.
All right, Alyssa, here you go. And while she is getting that, I had Mr. Theodore had asked earlier on the presentation, about 10 minutes in, you were looking at some statistics, and he said, is there a reason that state and municipal possible corporate debt is not included in these statistics? Does that question make sense to you, Brian, or should I move on?
Yeah, all debt has risen over that time frame. I'm just trying to keep things simple by the uh, most popular, if you will, statistic and most alarming of the statistics being federal debt. But yeah, individual debt actually varies a bit more because sometimes individuals take on more credit card debt. But yeah, debt in general has risen over that 45-year period because it makes sense to be a debtor. If tomorrow's currency and tomorrow's interest rates are going to be lower and the currency is going to be worth less, then you want to be a debtor because your debt depreciates. You do not want to hold that debt because the value of that debt again depreciates. So yeah, I simply am trying to keep things simple and not include all debt, but they have risen alongside.
Thanks, Brian. I know we have a few more questions here, but just in the interest of keeping things to time, I'll try and squeeze one more in. Eddie had asked a nice and quick question here. Do you recommend GDX and GDXJ?
I recommend them now for the rest of the audience that may not know, GDX is an index and ETF, excuse me, of the major mining companies. GDXJ is putatively an index of the junior mining companies, a level below, but still, even the GDXJ, the companies in GDXJ are fairly large producers and fairly large companies in the overall mining sector. So GDXJ is supposedly a bit more volatile and have a bit more upside than the GDX. Now, the mining sector is extremely inefficient as investment sectors go. This is a feature and not a bug. It is something you can put to your advantage if you are willing to do your research, even in the big ticket gold producers. You can find the outperformers yourself. If you're willing to do a bit more research, a little bit more legwork and skull sweat, by subscribing to some of the better publications, by going to some of the conferences and talking to the management teams of mining companies, you can find gems that the market has temporarily left behind. You can find companies that are due for re-rating that the market has just not gotten to yet. You can find exciting drill plays, exploration plays that the market is broadly unaware of yet. And you can outperform. And you are to some degree accepting a little greater risk, but you can have a lot of fun doing that too. If you're not willing or not able to put in that amount of work, then I would recommend that you stick to GDXJ and GDX. In a typical bull market, those will go up 4 to 5 times. They've about doubled so far, so you still have a lot of gains ahead if this is a typical bull market, but some of those gains have already been realized. If you want to know the best newsletters, including, of course, Gold Newsletter, but I have friendly competitors who put out great publications and conferences. I have friendly competitors who do great events. You can get all of that, including a primer on how to invest in precious metals across the board, from soup to nuts, in every manner and shape and form, by getting our Investor's Guide to Gold and Silver. It is free at goldnewsletter.com.
All right. Well, Brian, thank you so much for joining us today. It's been a pleasure having you on and to present. I know our audience appreciates all of the important information that you shared with us too.
Thank you, Charlotte, and thank you, everyone.
Absolutely. And of course, to those watching live, thank you from us at Money Show. And be sure to stay tuned as we have a lot more in store for you in this Money Show Virtual Expo. I hope everyone has a wonderful rest of your day. Take care.